Welcome everyone. Today we are looking at topic 10 in your SS1 accounting series, Accounting Concepts and Conventions. This is the final topic in our SS1 accounting series. Accounting concepts and conventions are the fundamental principles that guide the preparation of financial statements. They ensure that financial information is consistent, reliable, and comparable. This topic appears regularly in your examinations. You must understand each concept and convention. Pay close attention. Let us begin. First, let me explain what accounting concepts are. Accounting concepts are the basic assumptions and principles that underlie the preparation of financial statements. They are also called accounting principles or accounting postulates. They provide a framework for recording and reporting financial information. They ensure that financial statements are prepared consistently. They help to ensure that financial statements are reliable and comparable. Accounting concepts are accepted by the accounting profession. They are used by accountants all over the world. Understanding accounting concepts is essential for understanding financial reporting. This is a key concept. Now, let me explain what accounting conventions are. Accounting conventions are the customs and practices that guide the preparation of financial statements. They are also called accounting traditions. They are not as rigid as accounting concepts. They are based on common practice. They help to ensure that financial statements are prepared in a consistent manner. They help to ensure that financial statements are useful for decision-making. Accounting conventions include the convention of consistency, the convention of disclosure, and the convention of materiality. Understanding accounting conventions is essential for understanding financial reporting. This is a key concept. Now, let me explain the difference between accounting concepts and accounting conventions. Accounting concepts are the fundamental assumptions. They are the basic principles. Accounting conventions are the customs and practices. They are the traditions. Accounting concepts are more rigid. Accounting conventions are more flexible. Accounting concepts are based on logic. Accounting conventions are based on practice. Accounting concepts are universal. Accounting conventions may vary. Both are important for financial reporting. Understanding this difference is essential for understanding accounting principles. This is frequently tested. Now, let me explain the business entity concept. The business entity concept states that the business is separate from its owners. The business is a separate legal entity. The transactions of the business are recorded separately from the transactions of the owners. The personal transactions of the owner are not recorded in the business books. The capital of the owner is a liability to the business. This concept ensures that the financial position of the business is accurately reported. It prevents the mixing of business and personal transactions. Understanding the business entity concept is essential for understanding financial reporting. This is frequently tested. Now let me explain the going concern concept. The going concern concept states that the business will continue to operate indefinitely. It assumes that the business will not be liquidated in the near future. This concept allows assets to be valued at cost rather than liquidation value. It allows for the matching of expenses with revenue. It allows for the deferral of expenses. If the business is not a going concern, assets would be valued at liquidation value. This concept is essential for the preparation of financial statements. Understanding the going concern concept is essential for understanding financial reporting. This is frequently tested. Now let me explain the money measurement concept. The money measurement concept states that only transactions that can be expressed in monetary terms are recorded in the books. Non-monetary items are not recorded. Examples include employee morale and customer satisfaction. These cannot be expressed in monetary terms. This concept ensures that only financial transactions are recorded. It provides a common unit of measurement. It allows for the comparison of different items. However, it ignores important non-monetary information. Understanding the money measurement concept is essential for understanding financial reporting. This is frequently tested. Now let me explain the cost concept. The cost concept states that assets are recorded at their original cost. They are not recorded at their current market value. This is also called the historical cost concept. The cost is the amount paid to acquire the asset. This concept ensures that assets are recorded objectively. It prevents subjective valuations. It ensures consistency in financial reporting. However, it does not reflect changes in the value of assets over time. Understanding the cost concept is essential for understanding financial reporting. This is frequently tested. Now let me explain the dual aspect concept. The dual aspect concept states that every transaction has two aspects. These are the debit aspect and the credit aspect. This is the basis of the double entry system. Every transaction affects at least two accounts. The accounting equation is based on this concept. Assets equal liabilities plus owner's equity. This concept ensures that the books are always balanced. It is the foundation of the double entry system. Understanding the dual aspect concept is essential for understanding financial reporting. This is frequently tested. Now let me explain the accounting period concept. The accounting period concept states that the life of a business is divided into periods. These periods are called accounting periods. They are usually 1 year. Financial statements are prepared for each accounting period. This concept allows for the measurement of profitability and financial position. It allows for the comparison of performance over time. The accounting period is also called the financial year. Understanding the accounting period concept is essential for understanding financial reporting. This is frequently tested. Now let me explain the matching concept. The matching concept states that expenses should be matched with the revenue they generate. This is also called the matching principle. Expenses are recorded in the same period as the revenue they help to generate. This concept ensures that profit is accurately measured. It prevents the misstatement of profit. It requires the use of accrual accounting. Understanding the matching concept is essential for understanding financial reporting. This is frequently tested. Now let me explain the realization concept. The realization concept states that revenue is recognized when it is earned. It is not recognized when it is received. Revenue is earned when goods are delivered or services are provided. This is also called the revenue recognition principle. This concept ensures that revenue is recorded in the correct period. It prevents the manipulation of revenue. It requires the use of accrual accounting. Understanding the realization concept is essential for understanding financial reporting. This is frequently tested. Now, let me explain the accrual concept. The accrual concept states that revenue and expenses are recorded when they are earned or incurred. They are not recorded when cash is received or paid. This is also called the accrual basis of accounting. This concept ensures that revenue and expenses are recorded in the correct period. It matches revenue with expenses. It provides a more accurate picture of profitability. Understanding the accrual concept is essential for understanding financial reporting. This is frequently tested. Now, let me explain the convention of consistency. The convention of consistency states that the same accounting methods should be used from one period to the next. This allows for the comparison of financial statements over time. If a change is necessary, it should be disclosed. This convention ensures that financial statements are reliable. It prevents the manipulation of results. Understanding the convention of consistency is essential for understanding financial reporting. This is frequently tested. Now, let me explain the convention of disclosure. The convention of disclosure states that all material information should be disclosed in the financial statements. This includes both good and bad news. The financial statements should provide a true and fair view. This convention ensures that users have all the information they need. It prevents the hiding of important information. Understanding the convention of disclosure is essential for understanding financial reporting. This is frequently tested. Now let me explain the convention of materiality. The convention of materiality states that only material items should be disclosed. Immaterial items can be ignored. Materiality depends on the size and nature of the item. An item is material if it would affect the decision of a user. This convention ensures that financial statements are not cluttered with immaterial information. It allows for the application of professional judgment. Understanding the convention of materiality is essential for understanding financial reporting. This is frequently tested. Now, let me explain the convention of conservatism. The convention of conservatism states that accountants should be cautious. They should not overstate assets or income. They should not understate liabilities or expenses. This is also called the prudence concept. This convention ensures that financial statements are not overly optimistic. It provides a safety margin. It prevents the manipulation of results. Understanding the convention of conservatism is essential for understanding financial reporting. This is frequently tested. Now, let me give you sample exam questions to prepare you for your test. What are accounting concepts? Accounting concepts are the basic assumptions and principles that underlie the preparation of financial statements. What are accounting conventions? Accounting conventions are the customs and practices that guide the preparation of financial statements. State the business entity concept. The business is separate from its owners. State the going concern concept. The business will continue to operate indefinitely. State the money measurement concept. Only transactions that can be expressed in monetary terms are recorded. State the cost concept. Assets are recorded at their original cost. State the dual aspect concept. Every transaction has two aspects. State the matching concept. Expenses should be matched with the revenue they generate. State the realization concept. Revenue is recognized when it is earned. State the accrual concept. Revenue and expenses are recorded when they are earned or incurred. State the convention of consistency. The same accounting methods should be used from one period to the next. State the convention of disclosure. All material information should be disclosed. State the convention of materiality. Only material items should be disclosed. State the convention of conservatism. Accountants should be cautious. Let me summarize everything we have covered today. Accounting concepts are the basic assumptions and principles that guide financial reporting. Accounting conventions are the customs and practices that guide financial reporting. The business entity concept states that the business is separate from its owners. The going concern concept states that the business will continue indefinitely. The money measurement concept states that only monetary transactions are recorded. The cost concept states that assets are recorded at cost. The dual aspect concept states that every transaction has two aspects. The accounting period concept states that the life of a business is divided into periods. The matching concept states that expenses are matched with revenue. The realization concept states that revenue is recognized when earned. The accrual concept states that revenue and expenses are recorded when earned or incurred. The convention of consistency states that the same methods should be used. The convention of disclosure states that all material information should be disclosed. The convention of materiality states that only material items should be disclosed. The convention of conservatism states that accountants should be cautious. Understanding accounting concepts and conventions is essential for accounting. This is Topic 10 in your SS1 accounting series. Study it well. It appears regularly in your examinations. Well done. This concludes our SS1 accounting series.